How do you think the stock market reached a value of $800 trillion? The answer is securities traded on global stock exchanges. For comparison, all cash and money in savings accounts and bank deposits combined equal just $215 trillion. And all real estate in the world is worth around $217 trillion. So why is the stock market so massive? Let's break it down. The popularity of the stock market comes down to a few key reasons. First, it sells a unique product. Securities that allow you to earn a share of a company's profits while avoiding most of the risks and headaches of running a business yourself. Returns on stocks are often much higher than on many other assets. For example, if you had put $130 into a bank account at 5% annual interest, by 2018 you'd have around $245. But investing the same amount into a portfolio of top American stocks would have grown it to about $715. You might say real estate can also deliver high returns, and you'd be partly right. Over the last few decades, both U.S. and international real estate have appreciated even more than the famous S&P 500 index. And this brings us to another major advantage of stocks: the low barrier to entry compared to real estate. Being property as an investment requires a huge amount of starting capital, and there's no guarantee that specific property will even increase in value. Meanwhile, you can start investing in the stock market with just a few $100s. So, how does this market actually work? Let's imagine there's a company called X. It manufactures car parts and wants to raise money to expand its business. To do that, it becomes a public company, issues shares, and lists them on a stock exchange. This process is called an IPO. Once Company X's shares hit the exchange, any investor can buy them. In simple terms, the stock exchange is like a marketplace where companies supply their products, securities, and investors choose which ones to buy. There are many exchanges around the world, so each company decides which exchange is the best place to list its shares. After Company X issues its stock, those shares become traded between two main participants: dealers and brokers. Dealers are large firms that buy and sell securities using their own money to make a profit. Brokers, on the other hand, are intermediaries that give investors access to the market. That means you can't just walk onto the exchange and buy a Tesla share yourself. You need to open a brokerage account, and brokers mainly earn money through commissions on their clients' trades. So, Company X has sold all its shares on the exchange. But how do we know who owns them now? That information is tracked by a registrar, a legal entity that keeps the official record of security holders. If the company issues other securities in the future, information about their owners can also be obtained through the registrar. But how are securities actually stored for investors? After all, everything on the stock market is digital. Nobody receives a stack of paper shares and keeps them at home. Still, ownership and transactions need to be recorded somehow. That's where a depository comes in. Depositories provide custody and accounting services for securities. Their systems contain records of which assets belong to each investor. In simple terms, the registrar keeps records for the company, while the depository keeps records for individual investors. Now imagine this. Every single day, millions, if not billions, of trades happen on stock exchanges. The same investor might buy and sell the same security multiple times during one trading session, and many of these trades are made using borrowed money. That's why the market needs another participant whose job is to verify that all transactions are settled correctly. This role belongs to the clearing organization. So, what actually happens when you press the Buy button in your broker's app? The broker sends your order to the exchange, where it stays until someone is willing to sell that exact security at your price. Once the buyer and seller agree, the exchange registers the trade and sends the information to the clearing organization. The clearing company checks whether the buyer has enough money and the seller actually owns the securities. Then it processes the settlement and forwards the information to the depository. The depository records the transfer of ownership, moves the money from the buyer to the seller, and transfers the security from the seller to the buyer. The trade is complete. There are still many details we didn't cover. Things like listing requirements, IPO specifics, over-the-counter trading, and more. If you'd like to learn about those too, let me know in the comments.